Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 240 on 2nd of June. So, will the markets keep consolidating like what we have seen so far? We'll discuss that on the Nifty chart later in the daily bite. But first, a look at the markets. So, market was fairly, I would say, listless and sort of range bound in the sense that energy stocks and IT, while they were rallying, many of the sectors were, somewhat in a limbo as to whether this rally is going to culminate into a new leg up, or as a lot of market observers are calling it as a sharp bear rally. That is yet to be seen, but it does seem like things are stabilizing, and the pressure from the global markets to go down has been waning. Although the FII selling has not stopped, it has reduced in the absolute numbers to some extent in terms of the amount of selling. So, not very clear, but yes, it is more optimistic than pessimistic over the last 1 week now that everything seems to be turning green, at least on a week basis. And even on the month basis, a lot of recovery has happened in the last week or 10 days. In terms of the internals, almost all sectors were up around 0.5%, whether small caps, mid caps, large caps, all of them were about 0.5% up. Within the weekend investing basket, we had NNF10, MI25, MI50, MI30 doing very well, above 1%. Then some of them were between 0.5% and 1%. And MIMT, all cap, MIATH, and MI CNX 200 with high cash limits sort of being sideways. So some of these strategies have recovered well in the last 6-7 days and are pretty much in line with the benchmarks. In terms of the top gainers within the top 500 stocks, we had Finolex Cables up 10%, Century up 8.5%, Karur Vaisya up 8%, IFB Industries and Fine Organics up about 7% each. RHIM has been a loser since many sessions, down again 5%. Apollo Hospital was down 5%. Brightcom also down 5%. Kajaria Ceramics and Info Edge down about 4% each. So, reasonably mixed bag of gainers as well as losers. So, coming to the today's discussion of whether we are going to consolidate more or here, what we can see here is that since about 2018 or even mid 2017, Nifty was gradually going up in a very secular trend at about 10% CAGR, I would say, over the last decade or so. And then we had this, a sort of an accident in the market, which recovered very, very quickly. The blue line is the 200 DMA. So, as you can see, in the last many years, the index came back up very quickly after going below its 200 DMA. But of course, this was a huge shock to the system, and it took almost 7 to 8 months or 6 months to recover from it. And since then, it had a huge run up from even after recovering from above the 200 DMA at 11,000, going almost 60 to 70% higher than that within a span of a year and a half or two. And then now it has been consolidating. So I feel this consolidation is somewhat like the consolidation we have seen in this part of the Nifty journey. So, it may just keep consolidating here till the valuations catch up. So, actually, if you were to hypothesize that what if COVID never happened? And if COVID never happened, maybe Nifty would have, maybe trudged along a 10% sort of or 10 to 11% sort of a growth path. So if we were to assume that, just before the COVID crash, let's say we assume that markets were at fair price, and that was at, let's say, 12,000 Nifty levels, and about 2.5 years have gone by. So maybe we could have been or should have been about 25% higher than where we are. So that would have meant somewhere close to about 14.5, 15,000 on the Nifty. If this was sort of a fair region, then to build sort of 25% on top of that, you would have been somewhere near 14.5, 15,000. So at 16,600, we are not very far from that hypothesized fair point. I mean, we are less than, let's say, 10% from there. So if there were an external shock to the system and the market does drop about, let's say, 5 to 10% from here, that would be a very fair point to get into the market if one were waiting for that. But I mean, levels of this nature, probably, I don't know if they can be ever achieved. One should never say never in the markets, but it doesn't seem like that. So from that perspective, if we assume that fair value is within 5-10%, and also we also cannot forget that the global monetary base has gone up 2-3 times in this period. So just from that perspective, if we see, then even 6,600 is very cheap, because there's so much money in the system now that multiplier impact of that money supply also has to be factored into the the fair valuation, so as to say. So what was worth $1 before cannot be compared to $1 anymore, because of the enhanced money supply, and of course every other currency is also printing in the same or similar multiple. So from that perspective, as well as from the perspective that we talked about, hovering around 200 DMA for almost 2 years, when a market hovers around the 200 DMA for almost 2 years, you can assume that it is very near its stable equilibrium and fair price. Otherwise it would not have been able to stay there for 2 years. So now we are below 200 DMA. We are about slightly more than 10 to 12% from the top. If we do get a leg down to near 15,000, I think that will be a really good opportunity to buy the markets or to add to the markets. But we will have to wait and see. There could be a sense that that we have seen this triple down sort of pattern, and we may gradually creep up back to 18,000. That is always possible. A lot of people are calling it a bear rally, but you can never really say, and hence you need to use non-discretionary ways of trying to enter and exit stocks, because your mind can really create stories in your head about what the market is going to do, and it may just not do that. It may just do the opposite. So but without getting biased about whether the market is going down or whether the market is going up, we need to follow a strategy, and that hopefully should lead us to the desired returns that we have. So this is all I had for today's daily bite. I hope you like it, and you are sharing it with your friends and family. Do let us know how you rate this exercise that we do every day in your comments, and we'll be happy to receive any feedback. Thank you so much. Bye.